Every powerful nation throughout history starts with ambition and momentum. A group of people, tribe, kingdom, or society finds a way to produce value, whether through trade, agriculture, conquest, or innovation. At first, prosperity feels almost natural, like a tide lifting everything around it. Citizens gain confidence in their leaders. Foreign neighbors take notice. Trade routes open, the economy hums with activity. This early rise feels unstoppable, but success contains the seeds of its own undoing. That might sound strange, but there's a reason powerful nations have a pattern. The issues that lead to decline usually begin early, long before any crisis becomes obvious. The root causes lie in human behavior, incentives, resource limitations, and how societies choose to manage money and promises. In the beginning, wealth is tied to something real. People produce goods people actually want. Farms yield food. Craftspeople create tools. Caravans bring spices and silk. Ports buzz with sailors. When production and trade grow, taxation becomes possible without resentment. Societies invest in infrastructure, roads, irrigation, defenses. As wealth builds, governments gain capacity to do more. This turning point feels celebratory. Governments, now flush with resources, begin to expand services. They protect borders better. They offer programs to help the poor. They fund art, culture, science. Citizens love the benefits, and leaders win praise. But every benefit has a cost. At first, it's manageable. The economy is growing faster than spending. But the pattern is predictable. Once a nation experiences prosperity, spending begins to rise faster than revenue. Why does this happen? Powerful nations operate on political incentive structures. Leaders get rewarded for delivering benefits now, not for saving for possible downturns in the far future. If you can promise more schools, more healthcare, bigger military, improved infrastructure, and still keep taxes moderate, that makes you popular. Popular leaders stay in power. Less popular leaders get replaced. Soon, governments start borrowing. Borrowing becomes normal. It feels practical. Why not issue bonds? Why not use debt to finance projects that might not pay off immediately? At the beginning, borrowed money is cheap and seems endless. Foreign investors want a piece of what's working. The nation's currency might become attractive globally, reinforcing confidence. But debt hides costs. Governments treat large borrowed sums like found money because the pain of repayment isn't immediate. And citizens rarely notice right away. After all, benefits are still flowing, and life seems good. The real danger lies in compounding interest and increasing obligations. More and more of the government budget goes to servicing past promises instead of investing in future growth. There's a psychological shift that happens. A prosperous nation begins to think of money as an artifact of status rather than a tool of productivity. People begin to assume that wealth is permanent. They forget that money represents real value, goods produced, services delivered, and labor exchanged. When that link loosens, a dangerous gap opens between perception and reality. At this stage, politicians start making big promises. Universal healthcare, free education, retirement guarantees, lavish subsidies, military dominance around the globe. These ideas are popular with the public. Leaders embrace them because voters love them. Nobody wants to be the politician who tells people that benefits must be cut or taxes raised. That would be political suicide. So the spending continues to grow faster than the real economy. Governments borrow more. They begin to manipulate accounting to hide true costs. They assume that future growth will cover today's overspending. And for a while, it works. Powerful nations with strong currencies and global influence can defer consequences. They can run deficits for years. They can print money. They can roll over debt. They can borrow in their own currency. All of this creates the illusion that limits don't apply. But they do. Money is not infinite. Debt always comes due in one form or another. And here's the core issue. Powerful nations rarely reach a natural limit until the problems are deeply entrenched. By the time warning signs appear such as rising interest burdens, slower economic growth, or declining investor confidence, it's often already too late to fix problems with minor adjustments. Let's look at some historical patterns. Ancient empires like Rome, Persia, and China all experienced long periods of rising wealth followed by gradual decline. No single moment wiped them out. Instead, what happened was a slow structural shift. The cost of maintaining empire armies, administrative apparatus, public programs began to outweigh what the economy could sustainably produce. Rome responded by devaluing its currency, reducing silver content in coins, and creating layers of bureaucracy that drained resources. In every case, leaders delayed the hard choices until they felt impossible to make. This is a critical point. Decline doesn't start with catastrophe. It starts with deferred responsibility, excessive promises, and political incentives that encourage short-term wins over long-term sustainability. Powerful nations believe they are immune because they have technology, military strength, culture, or global influence. But none of that stops financial reality. When spending consistently outpaces income, three main mechanisms appear: debt expansion, monetary expansion, printing money, and taxation increases. Each of these has consequences. Debt expansion increases future obligations. Printing money dilutes the value of existing money and can lead to inflation. Tax increases slow economic activity by reducing incentives for production and investment. Over time, these effects compound and undermine growth. Meanwhile, citizens get used to rising benefits but don't always notice the hidden costs. They might see infrastructure decay. They might feel tax burdens rise. They might notice prices creeping up, but these changes are often gradual. Human psychology adjusts quickly to shifting baselines. That makes slow decline much harder to detect until it's deep into the process. This is why nations rarely collapse suddenly and catastrophically. Instead, they decline slowly. Standards of living stagnate. Confidence wanes. Young people see fewer opportunities. Middle classes shrink. Inefficiencies grow. Power erodes internationally. All of this occurs long before any dramatic event signals collapse. There is also a second hidden factor: currency dominance. When a nation's currency becomes widely used globally, it gains a financial advantage. Other countries hold that currency as reserves. Foreign governments, companies, and investors buy debt securities denominated in that currency. This creates a demand that keeps interest rates lower and borrowing costs manageable. But currency dominance is a two-edged sword. When you borrow in your own currency, you can always technically pay back by creating more currency. This sounds like a safety net, but it encourages excessive borrowing and delays reckoning. The danger is that when confidence in the currency weakens, that reserve demand dries up. Suddenly, the cost of borrowing spikes. Investors become wary. The currency loses value. This is not a distant theoretical scenario. It has happened in various forms throughout history whenever confidence erodes. In powerful nations, politicians and citizens often avoid facing these realities. They prefer optimistic narratives. They believe in technological solutions, innovation, future growth, rising productivity, and other positive trends. But these narratives often ignore basic economic limits. Productivity matters more than luck. Real value matters more than credit lines. Sooner or later, the invisible costs catch up. Debt obligations must be serviced. Interest payments take a bigger share of the budget. Fewer resources are left for investment. Structural deficits widen. Confidence slips. Credit ratings drop. Investors demand higher returns. Borrowing becomes more expensive. And suddenly the nation cannot sustain the spending everyone has grown accustomed to. There is one more psychological effect at play. In powerful nations, the public often believes that their country's success is special, that their history, strength, or identity somehow immunizes them against decline. But economic reality does not discriminate. Productivity, incentives, costs, trust, and behavioral incentives operate universally. The foundation for why money problems in powerful nations are rarely about scarcity or bad luck. They are about how systems evolve, how promises are made, and how incentives shape decisions over time. We'll dig deeper into what happens when debt spikes and money loses value, and how nations try to hide the problem before it becomes obvious. We saw how powerful nations start with real economic value and gradually build systems that spend more than they earn. Now it's time to explore what happens next: how debt escalates, how money weakens, and why powerful countries often use clever financial tricks that only delay the inevitable. Once a government starts borrowing, the real danger is not just the amount of debt. It's how debt changes behavior. Governments begin to think of borrowing as routine rather than exceptional. They assume that debt can be rolled over indefinitely. When interest rates are low, this assumption feels justified. Low rates make payments manageable. Borrowing seems affordable. The problem is that borrowing today creates obligations tomorrow, and future economic conditions are always uncertain. The first major mechanism a nation uses to mask financial strain is monetary expansion. Central banks, often in coordination with governments, start injecting new money into the economy. The reasoning sounds harmless: stimulate growth, prevent recession, make credit cheap. But what matters is not the intention. What matters is the effect. When the money supply expands faster than economic output, each unit of currency gradually loses value. This is inflation. Inflation is not evil in all circumstances. Mild inflation can be a signal of healthy economic activity. But when inflation accelerates because of excessive money printing, its effects are corrosive. Prices rise faster than wages. People with fixed incomes lose purchasing power. Savings shrink. Investors demand higher returns to protect against inflation, and confidence in money weakens. Powerful nations often ignore rising inflation early because they have tools to mask it. They may adjust how inflation is measured. They may deflect blame to external factors like global oil prices or supply disruptions. They may point to rising asset values as evidence that the economy is still strong. But masking inflation doesn't stop it. It just hides the discomfort. Debt itself becomes more expensive over time. Even if interest rates were low at the start, borrowing more pushes up demand for credit. As debt piles up, lenders become cautious. They demand higher interest rates for risk. When a nation's credit rating drops, borrowing becomes costlier. Interest payments take up a larger share of the budget. Money that could have gone to infrastructure, education, or innovation now goes to service the past. Soon, governments face a choice: cut spending, increase taxes, or borrow more. Each option has political and economic pain. Cutting spending means reducing benefits that citizens have come to expect. Raising taxes discourages investment, consumption, and economic activity. Borrowing more deepens the long-term problem. So governments often choose the least painful option in the short term. This creates a feedback loop. More borrowing leads to more debt, higher interest costs, and greater reliance on monetary tricks. The public hardly notices at first because benefits and services continue. But beneath the surface, problems compound. At this stage, powerful nations often turn to creative accounting. They move liabilities off official balance sheets. They use financial instruments that postpone costs. They engage in currency swaps, special funds, and other mechanisms that obscure the true size of obligations. On paper, the nation still appears strong. In reality, obligations are spreading across hidden categories. Another factor makes this stage even more dangerous: global financial integration. Powerful nations with dominant currencies enjoy what economists call a privilege. Their debt is widely held. Foreign governments, corporations, and investors hold large quantities of their bonds. This creates demand that keeps yields relatively low. It also allows these nations to borrow at rates other countries can't access. At first glance, this seems like a tremendous advantage. And it is until confidence begins to fade. Because when confidence weakens, investors diversify away from that currency. They demand higher returns. The sudden shift in global financing conditions can be abrupt. When a nation's debt is large, even a small rise in interest rates can massively increase the cost of servicing that debt. At this point, the nation faces real stress. Its currency might begin to lose value relative to others. Imports become more expensive. Inflation rises further. Citizens feel cost of living increases. People with fixed incomes get squeezed. Young workers see fewer opportunities. Governments face pressure to intervene more, not less. When confidence erodes, powerful nations sometimes resort to extreme monetary policies. They print more money to cover obligations. They bail out troubled sectors. They expand guarantees. These actions temporarily prevent collapse but deepen long-term instability. The currency weakens. Investors seek alternatives. The nation's financial reputation is damaged. Another problem arises: structural deficits. This means the government's normal revenue is consistently insufficient to cover basic spending without borrowing. In early stages, deficits might be cyclical, tied to recessions or temporary downturns. But structural deficits are different. They reflect a permanent gap between revenue and spending. Once a deficit becomes structural, it rarely goes away without major reform. The reasons are political as much as economic. Powerful nations rarely cut popular programs. They avoid raising taxes. They promise more benefits. This becomes a cultural norm. Spending on anything that looks like a social safety net or economic booster becomes sacred. People view cuts as unfair. Politicians see cuts as career-ending, so deficits become permanent. This is where public trust plays a crucial role. People need to believe the financial system and the currency are stable. Once trust wavers, behavior changes. Individuals spend differently. Businesses postpone investment. Foreign partners move reserves elsewhere. Confidence is not a number you can measure precisely, but it is real in its effects. Debt, inflation, and confidence interact in complex ways. The economy can still grow for some time, but growth becomes increasingly dependent on financial manipulation rather than real productivity gains. Real productivity requires innovation, investment, efficiency, and effective institutions. When financial factors dominate, real economic capacity erodes. Another common response by powerful nations in this phase is to shift the burden onto future generations. Leaders argue that today's benefits are necessary and tomorrow's economy will be bigger and richer. But predicting high future growth becomes harder as debt ratios rise, interest costs climb, and productivity slows. The promise of future wealth becomes less credible. People start to notice. Young workers see stagnant wages. Middle-aged families struggle with costs. Retirees find savings worth less in real terms. These are slow changes, but they accumulate. Over time, the public demand shifts from optimism about the future to fear of decline. At this point, the nation may still appear strong externally. It may continue to lead alliances. Its military might remain dominant. Its culture might be influential. But internally, financial foundations are eroding. This internal weakening eventually affects external power too. Military budgets grow, even as the economy shrinks relative to others. Foreign policy becomes harder to sustain. As confidence drops, so does willingness to invest. Capital flees to more stable environments. Skilled workers emigrate. Domestic innovation slows. These changes don't happen overnight, but they are real and measurable. Once positive feedback loops turn negative, reversing them becomes politically painful and economically costly. In history, we see examples where powerful nations tried to ignore these realities until the pressure became too great. They delayed reforms. They promised more benefits. They borrowed more. They expanded monetary policy. And each delay made eventual correction more severe. We'll explore how decline becomes visible to the public, why reforms are avoided until it's too late, and how cultural, political, and psychological forces drive nations deeper into financial trouble. We'll also talk about what successful nations do differently when they face early warning signs. We explored how wealth builds, how debt accumulates, and how powerful nations often use financial tools that delay reckoning. Now we reach the final phase, the stage where decline becomes visible, where public expectations collide with economic limits, and where choices become unavoidable. This phase usually starts quietly. Citizens begin noticing small changes. Prices on everyday goods seem to rise faster than wages. Public infrastructure looks older, services seem slower. Government promises feel less reliable. Young people talk more about limited opportunities. These changes might appear subtle, but they have a cumulative emotional effect. The sense of confidence that once felt natural now begins to slip. One of the earliest visible signs of financial strain is increased public frustration. People feel that the system is not working for them the way it used to. They may blame politicians, corporations, globalization, technological disruption, or cultural trends. All of these factors can play roles, but often they mask a deeper underlying cause, a structural mismatch between expectations and economic reality. Powerful nations reach a point where the gap between what citizens expect and what the economy can sustainably support becomes too large. Governments respond in several common ways, each with consequences. One response is to promise even more programs and benefits. This sounds counterintuitive, but in times of economic worry, politicians often double down on promises as a way to win support. They offer subsidies, tax credits, expanded healthcare, student loan forgiveness, universal guarantees, or other popular programs. At first, these kinds of promises seem appealing to the public. But if they are funded through borrowing or expanded monetary policy, they worsen the structural imbalance. The cost of fulfilling these promises increases the very gap the promises were meant to bridge. Another common government response is increased regulation and intervention. Leaders may try to control prices, cap interest rates, or subsidize failing industries. These moves can create temporary relief for certain groups, but often distort economic signals. When price controls are put in place, shortages can emerge. When interest rates are kept artificially low, investment decisions become skewed. Intervention slows the natural adjustments that healthy economies depend on. When these internal policies fail to produce sustainable growth, governments often shift toward external narratives. They blame foreign competitors, unfair trade practices, geopolitical rivals, or economic enemies. These narratives can rally national pride and temporarily deflect attention from internal issues. But external blame does not fix internal structural imbalance. It can make it worse by encouraging protectionism, trade barriers, and military spending that drains resources further. In powerful nations facing decline, you often see rising division within society. Different groups compete for limited resources. Younger and older generations clash over social priorities. Urban and rural populations feel increasingly disconnected. Regional inequalities grow. These social tensions are not only economic, they are emotional, cultural, and political. As divisions increase, consensus on difficult reforms becomes harder to achieve. Reform requires compromise, shared sacrifice, and often painful choices. When societies are polarized, choosing sacrifice becomes nearly impossible. Politicians, sensing this, promise more rather than less. Debt grows. Spending rises. Confidence weakens. A critical turning point arises when debt service costs begin consuming a large share of the national budget. Instead of investing in infrastructure, education, or technology, governments must pay past obligations. Interest payments limit future options. As debt burdens rise, the government faces shrinking fiscal space. They have fewer tools available to respond to economic shocks. At this stage, inflation may also accelerate. If borrowing costs become too high, governments may rely more on monetary expansion. Money printing fuels price increases. Inflation erodes savings. People on fixed incomes suffer. Asset prices such as real estate or stocks may inflate, but the general population sees higher costs of living without proportional income growth. This mismatch creates frustration and anxiety. This economic squeeze also affects global standing. Powerful nations that once led alliances or commanded financial systems find their relative influence shrinking. Other economies might grow faster. New financial hubs emerge. Trade partners diversify away from dependence. The dominant currency slowly loses its privileged role as others offer alternatives. The decline is incremental, but once again, that's what makes it hard to notice until it's deep. In this phase, people look for simple explanations and quick solutions. Politicians offer slogans. Media promotes narratives centered on identity, blame, or superficial fixes. But superficial solutions do not address underlying economic imbalance. They can even hide the seriousness of structural decline. One critical psychological shift occurs here: the transition from optimism about the future to fear of loss. For decades, people might have believed each generation would be better off than the last. But when economic stagnation takes hold, that expectation weakens. Families postpone major life decisions like buying homes or starting businesses. Young talent leaves for opportunities abroad. Businesses delay investment. This slows economic momentum even more. When decline becomes visible but not yet crisis level, there is still a window for meaningful reform. Successful examples in history often involve leaders and societies willing to acknowledge limits early. They make hard choices, reducing excessive spending, reforming entitlement programs, investing in productivity, and aligning expectations with economic capabilities. These changes are difficult and unpopular in the short term, but they stabilize the economy and preserve long-term options. Reform requires honesty and shared sacrifice. It requires meaningful public dialogue about priorities and limits. It also demands institutions that can plan beyond political election cycles. When these conditions exist, powerful nations can adapt. But when reform is delayed until crisis is unavoidable, the consequences are steeper, cuts become deeper, unemployment rises. Confidence plunges, markets panic, currency values fall. Social tension spikes. External competitors sense opportunity. This stage is painful and often results in a long period of economic and social instability. So what can individuals learn from this? First, understanding that powerful nations are not immune to economic limits helps set realistic expectations. Second, financial literacy understanding debt, inflation, productivity, and incentives empowers people to make better personal economic decisions. Third, recognizing early warning signs can help citizens engage constructively in public debate. On a broader level, nations that face early structural imbalance have options. They can reform entitlement programs, streamline government spending, and invest in productivity-enhancing sectors. They can encourage innovation, support workforce development, and create stable regulatory environments. They can strengthen public trust through transparency and accountability. The most successful societies are those that balance ambition with realism. They celebrate growth, but they also acknowledge limits. They invest in the future, but they avoid unpayable promises. They engage citizens in honest conversations about trade-offs. They build resilience in good times, so they are better prepared for challenges. This does not mean avoiding change or rejecting progress. Quite the opposite. It means building foundations strong enough to support progress without creating fragile systems dependent on continuous borrowing or manipulation of financial signals. At the end of the day, decline is not inevitable. It is a risk that emerges when economic behavior and political incentives diverge from long-term sustainability. Wealth, after all, is not just numbers in an account or power projected abroad. It is real capacity production, innovation, human capital, and trust. When nations forget that, they borrow too much, spend too freely, and promise too much. When people and leaders focus on short-term gains at the expense of future stability, debt becomes a burden. When confidence erodes, currency weakens. When productivity slows, the gap between expectations and reality widens. The story of decline in powerful nations is not a mystery. It is a pattern driven by human decisions, incentives, psychology, and systems that reward short-term gain over long-term balance. Understanding that pattern helps us see where we are now and where we might be headed. It helps us ask better questions. It helps us recognize that financial stability requires more than fancy indicators. It requires discipline, honesty, shared sacrifice, and a willingness to face hard truths early rather than too late. And for every nation that has declined, there are others that adapted and survived. The difference lies not in luck, but in choices.